Hi there, healthcare colleagues. So today's topic is diversification. It is not what you think. So obviously, most of you have heard about diversification, essentially not putting all our eggs in one basket. Spreading your money around is essentially a risk management strategy, not so much an investment strategy, but a risk management strategy. So if one investment goes down, then you have other stable investments, and some other investments have counteracted this and gone up. So diversification, although it may minimize the ROI, your investments are essentially safer. In today's video, we're going to discuss diversification and how it's not what you think. Robert Kiyosaki clearly said diversification is not just spreading your money around in the stock market, and he has a lot to teach on that. He also called diversification Deworsification, and I'll explain why that is. So in today's video, let's discuss diversification from a broader perspective, and then help you understand what steps you can actually take to diversify your portfolio from several different perspectives. For those of you who are new to the channel, I'm Dr. Ron Wuest, a psychiatrist of 33 years. I make educational videos on emotional well-being and financial freedom to help healthcare professionals avoid burnout, achieve financial freedom, and emotional well-being in less than 15 minutes per day, because essentially school never taught us to care for ourselves. Warning, boring alert. My family tells me I'm still boring, and I promise if you stick with the video, yes, I may not be as entertaining as some, but I will help make complex concepts more simple. Believe me, if I can do this stuff, you can do it. So if you don't watch all the way through, I have warned my family that I may have to take out the sock puppet to get your attention. Don't make me take out the sock puppet. I'll embarrass myself and my friends and family. Just as a disclaimer, I'm a coach and educator. Please consult always with a trusted medical, legal, financial advisor before you make any major life decisions. So now let's jump into it. Warren Buffett called diversification a hedge against ignorance. So why did he say this? It's because obviously if we knew what to invest in, we would just put all our money in that. So what's the opposite of diversification? It's concentration. Concentration is essentially putting all your eggs in one basket, meaning if you knew an investment was going to go up 20%, not only would you take most of the money you had and put it in that, but you'd also borrow money at 7% and invest all in this one investment. But we don't know which investments are going to go up with certainty. So we diversify to really hedge our bets. This again is a risk management tactic, and Kiyosaki had some interesting things to say about diversification. He called it Deworsification because he really believes there are much better ways to invest than putting all your money in the stock market and spreading it around. Specifically, he says if he buys Microsoft stock, he can't call up Bill Gates and tell him how to run the business. So in fact, he would have no control over that investment in Microsoft. So rather, Kiyosaki believes that we should educate ourselves about principles, acquire skills, and invest in ourselves through education, and then developing and investing in business and real estate, which in fact we can control and have control over the asset this allows us to manage it in a manner where we know we can likely increase our profit and ROI that we receive. Now, there are many ways to think about diversification other than just spreading your money around in the stock market. But speaking of the stock market first, one of the ways to invest and diversify within the stock market and outside the stock market is called sector diversification. So sector diversification might look at tech stock, utilities, energy, healthcare, consumer goods, and someone might spread their money around these different sectors. And in that case, if one sector tanks, the other sector might go up. And so what affects this are obviously economic changes, technology changes such as artificial intelligence, geopolitical events can affect which sectors to invest in, like war might favor aerospace. Geopolitical issues could essentially guide us to one sector versus another. A second type of diversification is called strategic diversification. So in strategic diversification, we look at all our investments, whether they're in the stock market or outside the stock market, and we say, let's divide these investments into different buckets. One bucket would be growth, which is high risk, high reward. Second would be high yield cash, or low risk, which is a low risk investment, which could be treasury bills. Third would be if something catastrophic would go wrong with the economy, then things such as gold or silver might be the investments that would go up in that scenario, or Bitcoin perhaps. And then cash flow investments such as dividend stocks, real estate, even businesses. And this is strategic diversification. Again, looking at growth, high interest cash, insurance such as gold, silver, Bitcoin, and then things that cash flow. And then based on your evaluation of how you think the economy is going to go, you'd put a different proportion of your investments. For example, if you thought the economy was going to explode, you might put a higher percentage of your investments in the growth bucket. If you thought there was going to be a severe recession, you might put more in the insurance and high yield cash. So that's strategic diversification. Then the next type of diversification is geographic diversification. You can do this again within the stock market, potentially outside the stock market. And this is investing in countries where you believe there are significant economic opportunities. So obviously many of us invest in the United States, but also, there could be real growth opportunities coming up in India. Things that definitely could affect this are the local economic conditions of that country, again, geopolitical events that are happening. And so another look at a different way to diversify is geographically. Then one of the things that people who invest in the stock market always look at is market cap diversification. Capitalization essentially says what's the total value of the company, and they rank these as small capital companies, medium, and large cap. The large cap obviously more stable, less potential upside. The small cap riskier, but maybe more potential upside. And then the medium strikes a balance. but they'll separate their money within these three areas to hedge against any different particular company size getting hit. The next way you can look at diversification is liquidity diversification. That is, how liquid are your assets? If you need cash right away, how quickly can your investments be converted to cash? So if the stock market were to crash and simultaneously you lose your job, you don't necessarily want to sell those investments when the stock market's going down. You'd obviously like to sell when you've made a profit. But if you don't have liquidity through other investments, you could really be in a cash crunch. And this is one of the reasons some people have to sell stocks even when the market has crashed. So having other liquid assets such as gold or silver, potentially outside the stock market, even Bitcoin, might be crucial in terms of liquidity diversification. Then I think one of the biggest things Kiyosaki talks about is asset class diversification. So he breaks assets down into really three specific areas. But let's just say you have a stock market and you have invested in different countries, you've invested in different sectors such as tech and consumer goods. You have some money in growth stocks, other that are yielding dividends. The thing that Kiyosaki points out is you're still in one asset class, and that's stocks. If you're just in stocks, you're always exposed to the risk of the stock market. So he divides asset classes into three different asset classes: paper, which he considers stocks and bonds; real estate, and he's talking about actual real estate, not REITs; and then businesses that you own; and then also commodities, things like gold and silver, and again, potentially Bitcoin, which actually, as of the time of this video, is doing quite well. And then another way to look at diversification is time diversification. And this is why so many of you have heard dollar cost averaging. So diversifying over time as the market cycles up and down, putting small amounts of money in the market or in investments over time will protect you, because you're not necessarily investing when everything is peaked at the top. You're investing also as it's going down, and maybe as the market also troughs. So related to diversification is, looking at your asset class. Are you just in the stock market? Well, you're not diversified. And then also this concept of rebalancing. If one of your asset classes or one of your diversification strategies gets out of balance, then you need to rebalance your portfolio. And so you don't have too much money in one bucket to protect all sides of the equation, and diversify in many ways you can see there are to diversify. So you're always staying balanced in the way you want to be diversified, depending on how you think the economy is going to grow. It also has to do with your age, your risk tolerance, and the current economic and geopolitical conditions. I heard an interesting speaker say that people attain wealth by taking larger risks when they're younger on a few things, and people preserve wealth by taking smaller risks diversified amongst a lot of things. So if you like this video, please click the like and subscribe site. Also check out my website, and that's all I got for today. You have a great day.